This conference will now be recorded.
Good afternoon, everyone. It is Wednesday, May 20th, and this is Kathy, Agency. I am pleased to bring you the continuation of our Monday, Wednesday, Friday webinars. If I could ask everyone to mute their lines, we're hearing a lot of background noise. Again, could everyone please mute their lines? Lisa? We're going to do this. Sorry about that. Again, it's Kathy Neifeld with Agency May 27th, and I am pleased to bring you, after the webinar, Alan Brown, a partner with law firm Georgia, and Alan is going to talk about estate planning pandemic. I have spoken to a number of estate planning attorneys when the pandemic started, and they have told me that they are ever. There's a reason, and that's because there are all kinds of planning opportunities that are available for clients today. So Alan's going to cover a number of topics, including dynasty trusts, family LLCs, gifts and sales to defective grantor trusts, and split dollar planning during this 30 minutes that we've got. If you've got any questions, please type them into the chat box, and we will address them at the end of the presentation. And without further ado, I'm going to turn it over to our dear friend, Alan Brown. Thanks.
Thank you, Kathy. Good afternoon, everyone. I am 64 years old and have worked as a lawyer for 40 years, and I plan to work 10 more years. My youngest son just finished his freshman year in college, so I still have bills to pay. My point is, over 40 years, I looked it up, I've now lived through 1 pandemic, 6 recessions, and 14 stock market crashes. So I've been sued for malpractice 4 times, and all 4 times I got the suits dismissed and paid nothing. But if anything has taught me in 40 years, it's that you can't predict the future. And we all hope the future is full of many good things, but we have to admit there are going to be some bad things. So we're going to talk this afternoon about asset protection planning. The simple rule of asset protection is if you do not own it, your creditors cannot take it from you. And what's interesting is that's the exact same rule for federal estate tax, gift tax, and generation skipping transfer tax. If you do not own it, the IRS cannot tax it. So we're going to do asset protection for asset protection's sake, but we're going to get protection from those federal transfer taxes, estate, gift, GST, without any additional effort. Can we advance the slides, please? So we're going to talk first about who should be looking. I think every family worth $5 million or more should be looking at asset protection right now. We know that there is a gigantic exemption from those transfer taxes, $11.5 million per person, $23 million. But what that means is when you're talking to someone about asset protection, you don't even have to bring up estate tax anymore because it's almost certain that they have more than enough exemption to cover whatever you're doing for asset protection. So I don't even need to discuss it. I just discuss asset protection. We're going to talk about a dynasty trust. A dynasty trust is simply an irrevocable trust that was funded by a gift that is exempt from those estate, gift, and GST taxes and operates for the maximum period of time in the state in which it's established. So dynasty trust is just a shorthand label that every lawyer, accountant, financial planner, and trust officer knows what it is. You don't have to put dynasty in the label, it just saves some time. So a trust is the most perfect, a dynasty trust is the most perfect asset protection in American law. And the reason for that is you cannot get to a creditor of the founder cannot get to those assets because the founder has no rights. A creditor of the trustee cannot get to those assets, the trust assets, because the trustee is not the whole owner of the trust. A creditor of the beneficiary cannot get those rights, cannot get to the trust assets because the beneficiary does not have the rights, 100% of the rights. So because we've split the ownership of those assets between the trustee and the beneficiary, and because the founder created the trust and then walked away, we have the most perfect asset protection available in American law. Can we advance the slides, please? The most popular kind of gift trust when I started practice was parents creating trusts for children or grandchildren, but they were only allowed to give $1 or $2 million, so that made sense. Now that we can give much larger amounts, I'm finding out parents are not willing to give up control of that much money. So instead, we are using almost exclusively husband for wife, wife for husband trusts. So pick any amount. Let's imagine we have a 2-career family and they have $2 million of investments that they've accumulated. Let's take a business owner who has either accumulated $2 million of assets, or there's a commercial building that the business operates and it's worth $2 million. Well, $2 million is worth protecting. That's going to double and triple and quadruple in value over 1, 2, 3, 4 generations of family members. So it's worth protecting now, and it's incredibly easy to do. I looked up, and Jim and Emma are 2 of the most popular names in America right now for newborn kids. So we've got Jim and Emma are married one to each other. They have at least $2 million of assets that they're willing to move into an asset protection trust. Jim creates a trust for Emma. Emma's the only beneficiary. Emma creates a trust for both Jim and her descendants, so that trust has multiple beneficiaries. That trust can have, those 2 trusts can have any group or any number of provisions and restrictions, whatever they want. The only rule is they can't be identical. The IRS has something called the reciprocal trust doctrine. If Jim and Emma sign documents that are identical to the comma, they say that Jim and Emma haven't moved their financial position. So the 2 trusts have to be different, but within that single restriction, those 2 trusts can say virtually anything. So Jim and Emma, between the 2 of them, will continue to have complete control of that group of assets, be it $2 million or a lot more than $2 million. They get the most perfect asset protection available in American law. And hopefully this is money that they will spend last. So if they are successful in all parts of their life, this money passes to children and grandchildren and great-grandchildren. If in fact they need to spend it, it's available. They can spend 100% of the trust down to 0. So they have not given up control. They have not given up their cash flow if they need it, with the understanding that this should be the last dollar spent because they are asset protected and estate, gift, and GST tax protected. You need to ask the question, what about divorce? I'm not a divorce lawyer, but sadly, I've seen a lot of clients go through divorce, and in all 50 states, the starting conversation is 50-50. Husband takes 50% of what was accumulated in the marriage, wife takes 50% accumulated in the marriage. So Jim and Emma need to understand that, but every client I've talked to says, so I get my trust, she gets her trust, so we're really going to be in the same position with or without the trust, even if we get divorced. And I've had every couple be comfortable with that. So we need a trust. That's our background, and that trust can be as small as $1 million or as big as you want. So you're talking to any couple that has, in my mind, $2 million that they're willing to protect. Advance the slide, please.
From 8 weeks to either 16 or 24 weeks is well as loosening some of the other related expenses, but that's
I
for
need
another
someone to
time.
mute that line.
Lisa, I need you to mute all the lines.
The next
We're all
piece,
set.
the next piece is a limited liability company. So I need to be clear, everybody who wants to do asset protection needs a dynasty trust. Not everybody needs a family limited liability company taxed as a partnership, what we'll call a family LLC. But it does add some very important features. We need to be clear, an LLC does not give the same kind of asset protection as a dynasty trust, but it does give some asset protection. And the asset protection is that a creditor who goes after someone who owns an LLC in his or her own name gets an asset that's not pretty. You'd love to have cash, you'd love to have securities, you might even be willing, if you're a creditor, to take real estate that you think you can sell quickly. What you don't want is an LLC interest, because as a creditor, you are an assignee. The creditor, the LLC interest has been assigned to you. You don't become a member, you don't become an owner, you don't have any voting rights, you have no right to demand distributions. So you may never, ever get any money out of this LLC. So lawyers who are in the collection business tell me that if there's a family LLC on the table, generally the creditor will take a discounted cash settlement. So that's what we're getting. We're getting the opportunity for a discounted cash settlement. So that's good asset protection, but not as good as the dynasty trust. So why do we have one? Well, first, it's a wonderful management vehicle. I took half of the assets and put it in Jim's trust, half of the assets into Emma's trust. Well, how do I manage those two halves? Well, if instead I put all the assets that need to be transferred into an LLC first, and then I just give half of the LLC to Jim's trust, half of the LLC to Emma's trust, I now have a single owner, a single place to manage those assets. The other issue that I've run into many more times than I expected is maybe grandparents made significant gifts to minor children, maybe parents made significant gifts to minor children, and those accounts have grown over time, and now you're supposed to turn those accounts over at 21. I've met someone the parent is still holding it and the child is 32. So there's a reluctance to turn over a big fat account of cash and securities. So the question is, what's a fair way to capture that? Keep the money in the family, give some asset protection. So in the example we're working with, this family business, this husband and wife who own a business and own a commercial building and some stocks and bonds. They have created an LLC. They've moved the commercial building, the stocks and the bonds in there, but they've got these couple of $100,000 of transfers for minors, uniform transfers to minor UTMA accounts for their children, and they're just not entirely comfortable turning that money over. So the custodian has the power to invest that money. So we're going to invest that money in the LLC. So when the child turns 21, or if the child's already 32 and you finally tell them about this account, what you give them is not a check for hundreds of thousands of dollars potentially, but you give them a piece of paper that says, congratulations, you are now a direct owner of the family business, the investment business. And as that, we're going to now teach you what you need to do to be a successful business owner in your own right. Advance the slide, please. So the steps are, we're going to form the dynasty trust. Jim and Emma are going to organize their assets. So at least what's going to be contributed is half owned by Jim, half owned by Emma. They are each going to contribute their selected assets to the family LLC. Emma, as custodian of the UTMA accounts, are contributing contribute those assets to the LLC. I am very comfortable that the UTMA accounts are actually better off. They now are part of a well-diversified portfolio instead of in maybe just a couple of securities. And in my example, Jim and Emma are going to be the co-managers, with the idea that at some point they're going to have one or more of the kids join them as managers. This is a fully operational family business, and the kids should someday learn how to run it so that they can run it after the passing of Jim and Emma. Now, I'm going to point out here that when you make a gift of a business interest, it is not worth 100 cents on the dollar because there's no public market and you're giving a minority interest. So I predict everybody on the call is comfortable with lack of marketability discounts for gift tax purposes and minority interest discounts for gift tax purposes. The point I would like to make, though, is if most people are making, compared to 23 million, fairly modest gifts, we really don't have to squeeze these discounts the way we did, say, 15 years ago. My last IRS audit, which had a family LLC with a nice diversified portfolio of assets, the agent who didn't want to do a lot of work and didn't want to hire her own appraiser simply said, the IRS current auditing position is we'll give you a flat 25%, no question asked. So I have clients in the last couple of years after that audit who are just filing their gift tax returns, not paying the $5,000 or $10,000 or $15,000 for a professional appraisal, and just are saying that the owner's appraisal is a flat 25% off. And CPAs have accepted that. So I do think we need to recognize that there's a valuation discount, but that wasn't the reason we set up the LLC. We set up the LLC for management purposes, and we set up the LLC to reach out and capture either directly from children or from UTMA accounts for children, assets that ought to be properly managed and ought to have some asset protection. Can we advance the slide, please? Okay, so the first line is full federal gift tax exemption available. If husband and wife have their $23 million of exemption and they are doing transfers less than 23 million, then we're done. We've accomplished everything. We're ready to make the gifts. We've created the Dynasty Trust. We funded the LLC. We're ready to make the gifts. We're finished. I just need to point out, though, that should you bump into someone who has either used a big portion of their gift tax exemption, or you've luckily bumped into someone who wants to make a bigger transfer, 30, 40, $50 million, congratulations, that's a great day. You can make a sale of everything over the exemption. These Dynasty Trusts are grantor trust for federal income tax purposes. Some people call them defective grantor trusts. And that means that Emma and Jim can sell assets, including appreciated assets, to their grantor trusts for a promissory note with no recognition of gain. So because the grantor trust is disregarded for income tax purposes, anything you do on the income tax side, sale of an appreciation asset that would typically trigger capital gain, disregarded. Interest on a promissory note, paid and received, typically reported as interest expense and interest income, disregarded. And based on a lot of rules in other areas, we're very comfortable that you can make a sale that is 9 times, let's say, when you're finished, that the original gift is 10% of the transaction and the sale is 90% of the transaction. So just to give you a sense of scale, $40 million in an LLC with a 25% valuation discount is 30. I'm sorry, let's do 30 and a third off to 20, and then let's do a sale of 10 times 30. I can move $300 million worth of assets in a combination of the gift and a combination of the sale to grantor trust. So I predict most of the people you're going to talk to are going to fall in the first category. They've got plenty of gift tax exemption. They're only going to use part of their 23 million. But you just need to hold on to the fact that should you bump into someone, the combination of a gift and a sale to the grantor trust, you can cover 300 million. And my prediction is 300 million will cover everyone. Just to point out, the interest rates as a result of the pandemic are just astonishing. You can now have a 20-year note within a family this month at 1.15%. June has already been announced. It's 1.01%. I don't know if it's going lower than that. So any family members that for some reason are hesitant to make big gifts, at the very least, try to get them to make a large loan for these incredible low interest rates, and then all the earnings of the assets inside the trust in excess of that interest rate, 1.01%, at least will be asset protected. So that's still heading in the right direction. Advance the slide, please. So step one, we established the dynasty trust, Jim for Emma, Emma for Jim and descendants, so that they're different. Step two, we funded the Client Family Investments LLC. Jim put in half of the assets that Jim and Emma want to put in. Emma puts in half of the assets, and then Emma as custodian collected all those assets that otherwise would be turned over with no asset protection to the children. Advance the slide. Step three, Jim makes a gift of all of his LLC interest to his dynasty trust. In the unlikely event that we need more power, multiply by 10 and we can go to a sale that big. Step four, Emma transfers her her share of the LLC to her dynasty trust. Again, if we need more firepower, she can go up to 10 times her gift with a sale. Uniform Trust to Minors Act are direct owners of the LLC units. When those kids turn 21, they'll be direct members of the Client Family LLC. So the bedrock is dynasty trust, husband for wife, wife for husband. The scale is anywhere from 2 million to 300 million. So it's a very flexible. You can add the LLC if there's some reason that that's an advantage. The management is an advantage, or the ability to collect assets in the hands of other family members is an advantage. The one thing that's not on these slides, but I keep reading articles that during this pandemic, everybody should be doing grantor retained annuity trust, GRAT or GRATs. I would say that's great after you've exhausted $300 million of gifts and sales. And the reason for that is the first 300 million of gifts and sales for any family are completely protected from all future taxes, estate tax, gift tax, generation skipping, transfer tax, for as many generations as that trust will last in that area. So for example, if you're in Florida, that's 360 years. If you're in Illinois, that's indefinite until they change the American legal system. The problem with a GRAT is it's a one generation transfer. It is impossible when forming a GRAT to exempt it from the GST, the generation skipping transfer tax, which means unless the next generation, the children, do some correct additional planning, there will be a flat 40% tax when the money moves from the children level to the grandchildren level. I personally am uncomfortable with hoping and praying that somebody gets it right in the next generation. So I'm not using GRATs at all. And you've got my telephone number if you want to have that conversation and discuss it. But the point is, What I'm talking about, dynasty trust and family investment LLCs are 5-generation, 10-generation planning. A GRAT is literally 1 generation and stop. If you don't do something else, there's a tax. Advance the slide, please. Okay, I'm talking to life insurance agents and someone's saying, how come we haven't talked about life insurance yet? And the reason is we needed to build the box first. And the box is the dynasty trust or the dynasty trust with the LLC. And I am a firm believer in life insurance. Life insurance is a very appropriate part of a diversified portfolio. I say to every one of my families, you should be insuring every single family member who's insurable, and you should collect those insurance policies into a portfolio that should be managed exactly like you manage a stock portfolio. Having said that, I need insurance agents to be very respectful of the world of a trustee. If I'm the trustee of a trust and I do everything perfectly, not a single person is going to say thank you. If I make any mistake, I am going to have to pay for that mistake out of my own pocket. It's called fiduciary duty, and a trustee of a trust is subject to the strictest fiduciary duty in American law, worse than directors or officers or any of a number of other kinds of fiduciary duty. So when you're talking to the trustee and you're saying, I want you to buy life insurance, I think you need to be respectful of that trustee's concern. The trustee is not going to want the trust to be 100% life insurance. Now you can do it and you can get, consents from the, founder and beneficiary, but the trustee is going to prefer that there's a diversified portfolio. The trustee isn't going to want to see that 100% of the cash flow goes to life insurance premiums, because then the trustee doesn't have any easy access to cash to make a distribution to a beneficiary if a beneficiary needs it. That leads me to split dollar life insurance planning. I have done as much as just about anybody in the country over the last 20 years in split dollar. I'm a huge believer in split dollar, and the change of the rules that we got from the IRS were all good, none bad, because we now know precisely what to do and that the IRS isn't going to challenge us. So I'm not going to spend time on the various designs. Most everyone on the phone knows those. If not, give me a call or send me an email and I'll update you. My point is, in my example, I had a couple that owned a profitable family business and then also owned some commercial real estate and some stocks and bonds. It was the commercial real estate and the stocks and bonds that went into the dynasty trust and the family investment LLC. Those are now the piggy bank, the family bank, the vault, the assets that are going to be protected, we hope, for several generations. The beauty of split dollar life insurance planning is that profitable family business, which has a solid positive cash flow, can be the source of all the annual premiums. And now you go to your trustee and you say to the trustee, I'm not asking you to use trust assets for 100% of the premiums. Think about what we just learned about interest rates. If you do the note version where all the trust pays is the interest, it's 1.01%. So now you go to the trustee and say, we're not going to ask you to pay the premiums. We're only going to ask you to pay a 1% annual interest charge on the premiums. So what does that do to the trustee? That greatly reduces the trustee's sense of risk. So number one, you should be able to buy more insurance because it's only the interest or the term insurance cost, if we structure it that way, which could be even less than 1%. Number two, you can do lots of different kinds. A trustee who says, I have to pay all the insurance and I get sued if the insurance doesn't pay, might be uncomfortable buying a non-guaranteed product. He or she doesn't want to get sued. If you've got a split dollar plan, which says no matter what happens to the cost of insurance, no matter what happens to the premiums, profitable family business will pay the difference, will pay all of those premiums. Now the trustee can say, yeah, I'd be very happy to look at non-guaranteed products because I have that flexibility. So I am not an insurance agent. I would never tell a client what they should buy. That's your job. You're the experts. My request is to be sensitive to the fiduciary duty restrictions that trustees live with and make it as pleasant an experience for them. Make it as low risk as possible. And I think using split dollar, where the cash for the premiums is coming from outside the trust, makes life better for the trustee, lots more flexibility in planning what types of insurance, how much of insurance, and the trustee isn't going to feel as restricted as if the trustee has to use exclusively the current assets in the trust. Ready for questions? Who has a question?
Thank you, Alan. If you've got any questions, I would appreciate it if you would just type them into the chat box, and we will make every attempt to address them. We do have a question. It says, if the life policies have living benefits and waiver of premium and return of premium, many hazards are covered. I think that's more of a comment than a question.
I agree that those are all positive things that you should consider adding to the life insurance policy. They don't, however, pay the premium itself in the event that the waiver of premiums don't kick in. We didn't talk about long-term care. I am a big proponent that a life insurance policy owned by a trust should and could have long-term care riders to them. Clients really like them. You know, some long-term care only companies have gone bankrupt, but you should feel very comfortable that a life insurance company is going to be able to stand by those. Of course, it has to be very carefully selected that the rider pays to the trust. So if the insured has a medical issue, the long-term care rider pays to the trust, and then we look to the trust instrument to see whether or not we can make a distribution out of the trust to that person. As long as it's structured that way, I'm a big fan of long-term care riders.
Thank you, Alan. We have another question, which says, when you say you have premiums come from outside the trust, are you saying that loans should be made to the ILET when referring to split dollar?
Right. Split dollar is one of two forms. Either it's the loan regime, in which the profitable family business simply makes a loan to the dynasty trust that owns the policy, or you can do the economic benefit, where the family business is going to get back a portion of the cash value, and the dynasty trust is going to only pay the term insurance cost. So those are the accepted two versions of split dollar, but in both cases, the profitable family business, the sponsor of the split dollar plan, is going to start by paying 100% of the premium to the insurance company, and then the dynasty trust will make its payment, let's call it a reimbursement for the amount of the interest or the term insurance back to the family business.
Terrific. I don't see, oh, we've got another question. Is the trust the owner of the policy? And if so, the accelerated benefits are paid to the owner as opposed to the insured?
Yes, absolutely. So that was my point. I'm sorry if I didn't make it clear. The policy applicant, owner, and beneficiary is the dynasty trust. If you have the insured be the measuring life for the long-term care accelerated benefits, that's fine. And when that insured has a medical issue that triggers that, the accelerated benefits can only be paid to the trust. If instead you could somehow pay it out to the founder who was the insured, well, then the founder insured would still have an incident of ownership in the policy, and you just wreck the whole thing for federal estate tax purposes. So that's why the long-term care rider has to be looked at very carefully, and it has to be absolutely certain that the only possible payment is from the insurance company to the trust as owner of the policy.
Thank you. Alan, we are now at 12:37. I want to thank you for your time. If anybody has any other questions, please feel free to reach out to myself or to Gonzalo, and we will make sure that Alan is informed of them and we will address them. This has been recorded and will be on the Agency One website along with Alan's presentation, so you can access it there. Alan, I want to thank you for your time. You have been extremely gracious and have always been a very good friend to Agency One. For the folks that are still on the phone, Alan plays well with other attorneys. He does not look to replace existing attorneys that are have been working with clients, but he works very nicely alongside them to further supplement and make sure that the clients have the protection that they need and the planning that is required. So we are happy to make an introduction and to further the conversation for you to have with Alan to ensure that your clients have great representation. I also want to remind everybody that we have another webinar coming up, which is Friday, and that is you have completed the EAP, now what? And we invite you to ask all of your key office personnel to join you on that webinar as well, because I know that they are going to find value in digging deep into the e-application process. We will be providing Alan's contact information on our website, or you can email Gonzalo or myself or Lisa Mitchell or anybody at your team at Agency One to reach out to Alan, and we will make sure that you've got the connection. So once again, Alan, on behalf of Agency One, thank you very much, and we wish everybody a safe and healthy week, and we look forward to speaking to you all again on Friday, if not sooner. Take care.
Thank you very much, Kathy.